Okay, welcome to the 2024 Employers Roadshow. This is the third session that we're carrying out this year. The session has been recorded and will be uploaded onto the Employers portal. As far as the agenda goes, it's broken down into three parts. The first part is a recording of the roadshow from Edinburgh last week. This takes approximately 50 minutes. If you've got any queries or questions, you can actually use the Q&A box to raise those as we go along. We will moderate the questions to ensure we don't have repeats, or if we feel that what you're asking is something which is specific to you as an employer. The second session we've got is a live Q&A session, which involves the trustees. We have Chair of the Trustees, John Bridger, attending, and also Kate Yates, who is the CEO of Plumbing Pensions Admin Company. The final session is a closed session. Both John and Kate will leave, and it will just be the employers only. So that's enough of me. Let's start the session with the recording.
Okay, ladies and gentlemen, thanks very much for coming, and welcome to the 2024 Employers Roadshow. Looking at the speakers for the day, there's myself. I'm Dean, I'm chair of the PPEL company. There is Graham, who sat next to me. He is the PPEL actuary. And there's Alistair, who is a PPEL director as well. And finally, I think everybody probably knows, there is Kate, and she's here representing the trustees as CEO of the admin company. In terms of the agenda, we've got quite a lot to get through today. The aim is to have an open session with the trustees present here, and then what we're doing is Kate will then leave at the break, and then we'll just have a session which will just be the employers only. The objective is to update you on the current position of the pension scheme, and also to look at some options that are available in terms of what's known as the journey plan. We can go into that more details with that later. And whilst we've got sections on the agenda for questions, if you have any questions as we're going through, please just indicate and ask the questions as we go along. I prefer an interactive approach with events like this, rather than people waiting for questions at the end, because again, it allows the questions to be put into context. Slide 5, I just thought I'd remind everybody who the board is of PPEL. We're made up of 3 directors from the employers. As you can see there, we've got Alistair, Chris and Gordon, and each of those have sort of experience of various sectors of employers that, you know, cover the cross-section of the PPEL grouping. We have 2 directors from the 2 main membership bodies, which is Rudy and John, and there's myself as the independent chair. If we now look at where we've got to, PPEL was only constituted in January 2023 following the governance review, and we really only got going in June 2023 once we'd constituted the board and appointed advisors. It has been rather a hectic first year. The first project we had to do was look at the legal framework within which we operate. Our role is quite restricted. We are here to represent all employers as a group, and that means we have to evidence how we have done that. So as part of that, we obviously hold roadshows, we run newsletters, and we also have to try and take into account the silent members who don't actually participate in any events. We've also, in our first year, also had to deal with the valuation. We have the 3-year valuation cycle. More about that later, and also more later about the journey plan. Now, the journey plan is basically the framework which tries to give us guidance and a plan in terms of where we want to get to, and how quickly we can get there. We've also had to comply with a pension regulator request, which is, even though there are no deficit contributions required, we have to put in place what would happen in the unlikely event that there is a DRC. And as part of our exercise this year, we've followed, I suppose, what you could classify as an industry norm, that any deficit contributions will be apportioned based on Section 75 liabilities. Finally, we also, as well as appointing our own actuaries, we've also had to appoint our own lawyers. And as part of that exercise, we've appointed Burgess Salmon, and they've very kindly offered to create an employer helpline. We've created a series of question and answers on our own employer-only portal, and there's also a telephone number there if you want to have any general legal advice. So it's been a very, very busy first year. And thanks to everybody for helping. So if I hand over to Alistair, I'll now take you through where we are in terms of the journey.
Hi, morning everyone. So we have to do a formal evaluation every 3 years, which Dean mentioned, and the ongoing one is at 5th of April 2023. We are quite some way through that journey, and we have preliminary results which are very positive, and we'll share a bit more detail about what those results look like later. One thing to mention along the way, it was important to confirm as part of that process that no contributions are expected to be payable by employers, which you'll see on this chart as well, and we've done so. Where we currently sit is the valuation has, subject to consultation and comments and feedback from employers, effectively being agreed in principle between the employer company and the trustees. And the main thing we want to discuss with yourselves today is the overall framework of what are we actually targeting? What's the ultimate target for this scheme? Where do we want to get to ultimately? And how do we get from where we are to that point? And that includes what the investment strategy might be. And so we have a number of options to present, and we want to take views from yourselves on what your preferences are with the strategic approach to get from where we are to the end point. So we're towards the end of this timeline, as you can see. Once we've got everyone's views, the employer company will take those on board and work with the trustees to finalize this journey that we want to be heading on, and also then sign off the triennial valuation. And that process needs to be completed by the start of July.
Thank you for coming here today. It's good to see so many of you here. As Dean has already said, it's been a really, really busy year for us. So I'm going to run through some of the key projects that we've been working on, give you a bit more information. As Dean said, I will step out of this meeting for the second half to allow you to have a free and open conversation without anybody from the trustee being in the room. But at a high level, some of the things that we've been working on, well, we've revamped the scheme website, the employer portal. It looks different. It's got lots of information in there for you. We've been working on the actuarial valuation, and I've got some more information about that. We've been looking at the investment strategy, checking that it remains appropriate and what, if anything, we might want to change. We've been doing some modelling to look at what the journey plan for the future of the scheme might look like. And we've also been upgrading the administration system that we use to hold all of the members' benefits to improve their experience. We're launching a self-service portal later this year, but we're also looking to automate as much as possible to get cost efficiencies. So I'm going to start today's session with some facts and figures about the pension fund, and then we'll move on to sort of some of the other projects that we've been working on. So this chart shows you a snapshot of the scheme's members. And there are broadly two categories of members. There's the members on the left-hand side, which we call deferred members. Those are people who have been contributing to the scheme. They've built up benefits, but they haven't yet retired. And what you can clearly see from this chart is that each year, as those people reach retirement age, the number of deferred members is reducing. On the right-hand side, we've got the people who are currently in receipt of a pension, the pensioners and the beneficiaries, so the spouses of people who were members. And that number is slightly going up, obviously, as new pensioners come in. Now, the reason why this chart is helpful is that at the moment, the target for the pension fund is to get to a point where we can buy annuities for all of the members and transfer responsibility for paying those pensions over to an insurance company. But insurance companies don't like long-dated risk. They don't really like insuring deferred members. So all of these people on the left-hand side of the chart, they will insure them, but they will just charge us an awful lot of money. So it's very, very expensive at the moment to insure those deferred members. But as you can see, we do expect the cost of buying annuities, of insuring the benefits, to come down steadily over time, because those deferred members are reducing at a fairly steady pace year on year. So that's quite important to bear in mind later on. In terms of magnitude, though, just to give you a feel for how much the scheme is actually paying out in benefits, every month we pay about £5 million in pensions to the members in the scheme. So that's £60 million a year that we pay out in pensions. And that money is met from the income that we get from the scheme's investments, and sometimes from realising capital. So that's the members. What about the employers? Well, over the year, the number of employers has reduced by 8. So at April 2023, there were 331 employers in the scheme. During the year, one employer told us that they wanted to trigger their debt. 3 employers went into insolvency, and 8 employers left because they agreed a flexible apportionment arrangement. So that's where there's an illegal agreement transferring the pensions liability from one entity to another employer in the scheme. So through the flexible apportionment arrangements, 8 employers left, but 4 new employers joined, leaving 323 employers at the year end. So these stats will be in the newsletter that we put out later this year, so you'll be able to see that. During the year, and quite an important part of the actuarial valuation that we do, the trustees' advisors carried out a covenant assessment. So they looked through at the financial information that's available out there in the public domain about all of the employers standing behind the pension fund. And they also used the information that you gave us through the scheme returns that we send you. And they did an analysis to assess the strength of the employer base. And you'll be pleased to hear, I hope, that they assessed the strength of the covenant base as a 2. So on a 4-point scale, where 1 is good and 4 is bad, the strength of the employer covenant is 2, or tending to strong. Now, some years is 2, some years is 3, but it seems appropriate that it is a 2, because the magnitude, the size of the scheme is smaller. The employer base, while declining gradually, is still reasonably significant. There are 323 employers here, and if an employer leaves, they need to pay a Section 75 debt, which brings money into the scheme. And we've got the lock-in rule, which makes it harder for employers to leave. So the covenant strength, being a 2, is in a good place. So as Alistair said, one of the biggest projects that we've been working on this year is the actuarial valuation. So this is a formal financial health check that we need to do at least once every 3 years. And the way that we go about that is that we give all of the scheme's membership data to the scheme's actuary. She runs some complex calculations, and she checks how much money the scheme has, and she compares that against what the scheme actually has. And when we did this 3 years ago in April 2023, the scheme was 99% funded, which meant it nearly had enough money to pay all of the benefits that were due at that time using conservative assumptions. Now, there was a shortfall in April 2020 of £31 million, and we agreed a recovery plan to make good that shortfall over 7 years by relying on the scheme's investments. And I'm pleased to say that when the actuary looked at the calculations in April 2023, the scheme was still 99% funded, but the shortfall had reduced to £9 million. And as Alistair had said, we're not expecting employers to pay contributions. The proposal that the trustee has put to the employer company is that £9 million will be made good by relying on the scheme's investments achieving a slightly higher investment return than the actuary has assumed in her calculations. But we do need to agree a recovery plan. And as Dean has said, the regulator has stepped in this year and asked us to work out what we would do in the event that we had a deficit that needed to be met by employer contributions. Now, we never have had a deficit on an ongoing basis, and in its nearly 50 years of running, the scheme has never had to ask employers to pay contributions. But the regulator says, in a hypothetical situation, if a deficit were to arise, how would you as trustees and you as the employer company deal with that? So the proposal is that if there were to be a deficit that did require employers to pay contributions, those contributions would be allocated in accordance with your Section 75 debts. So that's allocating them sort of fairly among employers according to the liability that you have in the scheme. Again, a hypothetical situation, but it's just something that we need to do. The last point on this slide relates to Section 75 employer debts. So as part of the valuation, the actuary does calculate what the Section 75 debts would have been on the valuation date for every employer who is in the scheme. Now, we don't routinely hand out that information to employers, but it is available to you on request. We don't send it to everybody because we know that some of you have been told by your accountants and your auditors that once you know that number, you ought to put it in your accounts. We don't think that's right. That's not what our advisors have told us because it's a contingent liability that hasn't been triggered. But to avoid putting any of you in a difficult position, if you want to know the number, come and chat to us after this or give us a call or drop us an email in the Edinburgh office and we can let you know what that number is for your business. How has the funding position changed since we did the formal check in April 2023? Well, this chart shows you how the assets and liabilities have changed over the last 12 months or so. The green line is the scheme's assets, the yellow line is the scheme's liabilities or technical provisions. The key point to note from this is they go up and down, but the good thing is they go up and down in a similar way. So when the value of the scheme's assets go up, the scheme's liabilities go up by a similar amount. When the scheme's assets go down, the scheme's liabilities go down. And that's partly driven by the scheme's investment strategy, which is shown on this slide. Now, some of you might recognise this because it's very similar to what we put into the employer newsletter every year. But that big, murky, greeny, horrible colour on the left-hand side is our liability-driven investment portfolio, which is managed by Legal & General. And that invests in government bond and government bond types assets. And the main purpose of that bit of our portfolio is a protection. So when interest rates change, when inflation rate changes, the values of the scheme's assets are designed to change by a similar amount to the value of the scheme's liabilities. And that has helped us ride through the last few years. If you think of all of the things that have happened in the global economy, we've been through Brexit, we've had a pandemic, we've had the cost of living crisis, Russia has invaded Ukraine. It's been a pretty bumpy journey. And yet the scheme's funding level has remained at and broadly at 100%, which is a really, really good position to be in. And not all pension funds can say that they're in as good, as strong a position today as they were in 3 years ago. So this slide is to sort of set the scene for what's to come, because one of the things that we've been looking at is whether this current strategy remains appropriate for the future. And Dean and the colleagues over there have got some information for you about what a changing the investment strategy might look like and what it might mean for how long the scheme needs to run on. But just as a brief summary of what the other categories in our investment strategy include, they include bonds, investments in company bonds, got a small bit in equities, stocks and shares in companies, and then we've got a reasonably large chunk in illiquid assets, so assets that you can't immediately sell because you get a premium for investing in sort of investments like property and infrastructure. And then at the very top, we've got a small percentage of our assets in cash and cash-like investments to make sure that we always have enough liquid assets to pay the members' benefits as they fall due. So in terms of your question, sir, in terms of the journey plan, how long is it going to take? Well, we've been doing some modelling with our professional advisors, and we've been looking at whether it might be appropriate to take a little bit more investment risk. Now that could, if it works, reduce the time it takes to get to the end point, but it also could increase the risk that employers need to pay contributions. So there's a real trade-off here. And as I said at the very start, we've got time to play with. If we've got time to play with, then as the deferred members gradually get older, it will get cheaper to buy annuities. It will get cheaper to get to that end point. But there's lots of different and competing factors here. So we are genuinely interested in your views and what you have to say today once you've seen the figures that we're going to present to you. Now, underlying the journey plan is the employer base, you guys. And the trustees the strength of the employer covenant is really, really important to the trustees. It's the factor, is the bedrock for running this pension fund. And part of the way that we are able to maintain that is through the lock-in rule. So I know some of you have been to our presentations before, and I'm preaching to the converted, but the lock-in rule prevents employers from leaving the scheme without trustee consent while the rule is in place. The trustees like this rule because it helps to protect the members' benefits. It keeps all of the employers linked to the pension fund. But from your perspective, it actually shields you as individual employers from the actions of other employers. It keeps everybody in the scheme together. Now, the lock-in rule has been reviewed and put in place every year, but the trustee would ultimately like the lock-in rule to be in place until we reach a point where it isn't needed anymore. And I can envisage that the scheme could potentially reach a particular funding level where actually you could ride through the volatility and the shocks. And if something were to happen and to knock the scheme off path, you would never need to come back to employers for contributions. And at that point, I don't think you would need the lock-in rule. But we haven't had those discussions. We don't know what point that is yet. So to allow time for those discussions to take place, for some of that modelling, for you guys to feed in your views as to whether you think that's an appropriate strategy, the trustee has asked the employee company to agree to extend the lock-in rule for 3 years, so from 30th of June 2024 to 30th of June 2027. And the rationale for that is that it ties into the time when we'll be doing the next actuarial valuation, because that will be due in April 26. So it gives us 3 years to come out, to get your views, to do some modelling, to work out at what point the lock-in rule might no longer be needed.
I think from PPL's perspective, obviously, as Kate mentioned, it's an annual renewal, which means the trustee can only rely on 12 months worth. What we've been looking at as part of this journey plan is that we don't expect the lock-in rule to be released within the next 3 years. So as a result of that, the PPL board's position is that, we're willing to support a 3-year lock-in rule, but what we expect to see is an impact on the journey plan. We expect the trustees to potentially rely on that covenant a little bit more and to, hopefully get more value from the investments. We also hope that as part of the journey plan, we'll have a position that we will agree a waypoint, that we'll go into this in more detail later. The idea being that, as Kate mentioned, once we hit a certain level of funding, the lock-in rule will naturally fall away. And the idea being is that the pension scheme has the base to ride out what it needs to ride out. And we agree with the trustees on that. So at the moment, we are relatively in support, like I say, provided we get a journey plan which achieves buyout on a quicker basis.
Okay, so how can you help us? Well, the employer portal is there for you. It's got lots of useful information in there about the pension fund. It's got all the employee newsletters, it's got the legal documents, it's got our reports, it's even got our first climate disclosures report for any of you who are interested in that. We really do genuinely need your feedback. The employer company is there and set up to represent the interests of all of the employers, but they can't make decisions in a void. And so when they consult with you, please do take the time to respond. Please also complete the scheme return. Nearly half of the employers that we send the scheme return out to don't complete it, which makes it very, very difficult from the trustee's perspective to make decisions, because in the absence of information, we have to assume a worst case scenario. If all of the employers completed the scheme return and we saw that the financial base was stronger, then it might support the trustees taking a little bit more risk, which might get us along that journey plan a little bit more quickly. But in the absence of that information, we have to assume the worst.
So as an example, you've got a situation on the last scheme return, when the covenant check was looked at, 43% of employers hadn't provided financial information. So that meant that the trustees had to ignore 43% of the employers in terms of the strength of the covenant. So again, that PPL also would request that you fill in those returns and provide the financial information, because it's fairer for everybody, and it is actually a legal duty to provide that information. So, you know, allows the pension scheme to be managed properly and more effectively.
Thank you. And the last point on this slide, please pay us your VAT invoice promptly. We run a really tight ship at Plumbing Pensions, and we need the money to pay out for the members' benefits. If we can keep the scheme's assets invested for as long as possible, they're working as hard as they can to get that extra investment return.
Okay, so we mentioned the journey plan a few times already and investment strategy. We're going to go through some detail of the options that we have available, and we'd like to get your views on all of this. What I'll do right now is set the backdrop to all of this first. So the employer company is here to represent the collective best interests of all employers and the views of all employers collectively. Naturally, there may be variation. There's different circumstances employers find themselves in. So, and different views people have. What we are trying to do and what we need to do is to look at collectively what's in the best interest of everyone. So that's a fairly challenging remit to be given, but it also shows why it's important that you actually help us and tell us what you think. And hopefully today you can share your views as well. Last year, we set out what our objectives were. And this is after taking some feedback from employers and looking at the situation ourselves and coming to our own view of what we think employers collectively want or what's in their best interest. So a few key aspects of that. Contributions. The scheme has not actually in the past ever had to collect deficit contributions from employers. Our understanding is that collecting or seeking to collect contributions would be quite challenging for many employers. And a key objective is to avoid that as far as possible. So we are trying to minimize the risk of there ever being a requirement for employers to pay contributions. That's important when we're thinking about the strategies that we are going to set out. Where are we actually trying to get to? There is one option that says, run the scheme on at a very low risk level. Don't actually try to speed up the process to get to buyout, which is relinquishing employers and all their obligations, securing the benefits with an insurance company. Just run the scheme on and pay members' benefits out of the scheme assets. The employers remain within the scheme and continue to be hooked with the scheme and supporting through their covenant strength the scheme through that whole process. Now that's one option. But that's not where we understand employers, or many employers are, because employers actually, a lot of them want to be relinquished of their obligations to the scheme. So this is quite important. This is why our objective is set to achieve buyout and securing the benefits with an insurance company. And the journey plan that we have been working with the trustees on, and we want to get your views on, is actually trying to get to a point where we can secure all these benefits with an insurance company as quickly as feasibly possible without taking some, shall we say, crazy amount of risk along the way. So there's a balance here. So we minimize the risk of contribution being called upon if we are thrown off course. So this is the essence of it, and that's what we're going to take your views on, and we're going to share some details about the various options we have a bit later. And I think on the next slide, I've more or less covered this, but effectively what we want to understand from yourselves are, right, we want to get to buyout. We have a number of strategies that we think are viable and how we get from where we are to that point. The more risk we take, the quicker we expect to get there. So the more investment risk we take, the higher the return we expect to get on the investments. And that speeds up the process to get there. But what you need to understand is what that's balanced against is the risk that we are actually blown off course a bit. And if we are blown off course, what that could mean is either it takes us a bit more time to get there because we have to reset things, or there's a risk of contributions being required if you're thrown off course. And none of these strategies we're putting forward are, if you will, putting all on red, as we say, or taking some what we think is irresponsible amounts of risk. We think they're all within reason, but they are from the low end of risk, which means taking longer to get to the end, to a medium level or to a slightly higher level of risk, which gets us there quicker. And I'll hand over to Graham now, who's going to take you through some of this in more detail.
All right. Thanks, folks. What I tried to do in this slide is just put into a little bit of a picture just how we see this journey plan unfolding for the scheme. So the yellow box there is effectively where we are just now. So if you see those blue bars as almost the level of assets kind of growing year by year for the scheme. So we're at a position just now, as the yellow box says, we're full funding what's called the technical provisions. Effectively, that means no contributions are being asked of the employer group. Alistair's talked about the ultimate goal, so that's the blue box and at the far right hand side. So what that is building up your assets to a point where you've got enough assets to be able to pass those to an insurer, effectively buying annuities for each of the members, that their benefits will be paid by the insurer moving forward, and it will allow you as employers to exit from the scheme, not to have that Section 75 debt hanging over you. You have a clean break from the scheme. So that's what the journey plan is looking to achieve, and we'll go into what sort of levers we've got in a second. The last thing to pick up on this slide is the green box. So the middle piece here, Kate touched on this when we talked about the lock-in rule. What PPEL and the trustees are committing to do is to have ongoing discussion as to what is there a point on that journey plan between where we are now and reaching this full buyout level that all parties could be comfortable releasing the lock-in rule, and that would be driven by, we would expect, a level of assets that would allow us to run a very low risk strategy that would mean a very low probability of ever having to come to the employers to ask for contributions. Discussions on that will continue. We're not looking to answer that question today, but the question we are looking for your input on is around the strategy that we put together to sort of power the scheme towards this ultimate buyout target. So in terms of what drives the time frame, right, to your question, the makeup of the strategy, this journey plan we're talking about, so there's three key levers to pull here that will influence the time frame to buy out, but also influence the sort of risk that things get blown off course, and those situations, the possibility that contributions may have to be asked from the employer group. So the three levers we've got are, number one, contributions themselves. So if contributions were being paid into the scheme, that would reduce the time frame to reaching this buyout target. From feedback that PPL have had, that has not been considered as part of the journey plan. The feedback has been that there is no appetite to pay contributions into the scheme, which we understand. So that's not in the makeup of the journey plan strategy that we will come on to speak about. That leads us to the middle box here, so that the investment strategy itself, and that really is the key lever in terms of what's powering the increase in the assets. So we have some options here. Alistair touched on this, so that there are a range of options from lower risk to higher risk. The higher risk that you take, the higher the expected returns on the assets will be, which means that the expected time frame to buy out will reduce. But this is a trade-off. So the more risk you take, the higher the expected return, but potential for the a larger downside. So if there's a bad event in the investment markets, you stand to potentially lose more, and the risk of the trustees looking for contributions from employers in order to meet the deficit that has built up, that will increase. And we will put some numbers to this just to give some context, just in a couple of slides' time. Last piece on this slide is covenant. Kate's touched on that, and Dean as well. The covenant underpins the investment strategy. So the stronger the covenant is, the more comfortable the trustees will be in taking a little bit more investment risk, because they know that if things are blown off course, there's a covenant there of sufficient strength to support the scheme. And that plays back to this view of PPL being comfortable to accept this 3-year extension to the lock-in rule, because it supports the ability to take a little bit more investment risk, and effectively gives us some more options that we can discuss with you today. So edging closer to the time frame piece, and there are some numbers up here on this. So just to sort of paint the picture in terms of where the scheme has come over the last 3 years. So that the chart shows 2020 valuation, the 2023 valuation. At both cases, there are no contributions being asked of employers. 3 years ago, at the 2020 valuation, this time frame to buy out was looking at about 20 years, probably 20 to 25. That has reduced, and we've put a range here at 2023 to say the time frame we expect now to be somewhere between 11 and 16 years. The reason we've got a range there is because there are a range of different investment strategy options that we'll take a look at shortly. Just on the next slide, just before we get on to the detail of the strategies, so there's so 3 key pieces we're going to look at in terms of putting a bit of context around what each of these strategies look like. So firstly, importantly, this time frame to buy out. So depending on the level of investment risk, there is a different time frame to buy out, so between 11 and 16 years. And then the other side of this coin, as part of the trade-off, is what a bad outcome might look like. So to illustrate this, so it is as part of the modelling that Kate referred to that's been done as part of the valuation, there's a range of outcomes that are looked at. So many different projections into the future. What we've done is we've picked the very bad scenarios, so say the worst 5% of potential outcomes, and said if that was to happen, and we will show what the impact on the deficit might be, and given a sort of illustration of what the deficit contribution ask might be of an employer of a sort of specific debt. We'll talk about it in a lot more detail shortly. Just to kind of, before I do move to the next slide, just to set the scene, there's 3 strategies on the next slide. The process that was gone through here was that the trustees engaged with PPL around the range of strategies to model and to test. Trustee advisors produced those numbers. There was then engagement between the trustees and PPL on this range of strategies, and we landed on 3 to show today. There were some almost at sort of the extreme ends of what we will show today, on some that had a very low risk. The time frame to buy out we felt was not favourable, so we haven't shown that today, and some that we felt were just too high risk, that didn't provide from PPL's view a sort of reasonable balance between that reduction in the time frame and the downside risk. To talk more about that shortly. So this slide's a lot of detail here, which I think is important to show, and let's walk through this and take some questions from you. So top line here, so years to buyouts. This is the average expected time frame to reaching buyout. So showing 3 strategies. That the lower risk strategy is where the assets are currently invested, and we expect on average going to be about a 16-year period to reach buyout. Medium risk, so slightly higher level of expected returns from the assets, means that it reduces to 13 years, and at the higher risk end, it reduces to 11 years. The piece below this on the chart, so this is when we look at the bad potential outcomes. So this is at an extreme, so the worst 5% of outcomes that trustees and advisors expect that we might say. Okay. So in the lower risk scenario, we're saying that there could be a potential increase in the deficit of about 70 million, so total scheme level. That increases to 94 at the medium risk level and 112 at the higher risk level. So you can clearly see that stepping up. And the next row down, what we've tried to do is to put that into what that might mean in cash contribution terms. Now, none of these are favourable outcomes, and we absolutely hope we don't see these situations. But we felt it was important just to give you a sense of this trade-off of the risk and return. So what we've shown here is, assuming an employer has a Section 75 debt of about £800,000, and I know not everybody knows their Section 75 debt, but just to give a sense, and helpful for those that do. The middle row there, so what we've done is for what we're trying to illustrate is for an employer that has a Section 75 debt of about £800,000. Now, I know not everybody knows their Section 75 debt, but it's helpful for a little context. If you have that level of Section 75 debt, this is an example of the level of contributions that might be asked for to meet this deficit that is opened up. So what we've assumed there is that contributions are payable for a 5-year period. So in the lower risk side of things, that's £42,000 per annum, £57,000 per annum in the medium risk, and 68 in the higher risk level. Now, if your Section 75 debt is higher or lower, those numbers would proportionately move. So yeah, interested in views from the room on this, and actually this some decision making around this, is really one of the key parts of the discussion today. From a PPL point of view, the moving up that risk level, we can see the appeal there in terms of reducing that time frame to buy out and accelerating the opportunity for you to leave the scheme. Clearly, that does come with some downside risk and a bad event. From PPL point of view, there was a feeling that, yes, certainly stepping up towards medium and then potentially exploring the higher risk option with you today felt favourable. But yeah, I'd probably pause there and take any thoughts.
I think in terms of this, probably one of the points to make is that when we go into the closed session, obviously Kate won't be here, so we can actually explore this discussion a little bit more in the next session, or we can carry on now. I'm quite easy either way, but I think it's very important to try and assess what's more important to people, the length of the journey or the potential risk. And the other thing to bear in mind as well is like Graham has alluded to, this is the absolute worst case scenario. One of the things you need to bear in mind is that it's not necessarily the case that it is linear in terms of the fact a bad event happens, that will be the contribution. Because one of the things you can do is we can then potentially stretch the journey plan again if a bad event occurs. So it's not guaranteed that there would be a requirement for deficit recovery. It is quite complicated.
It's probably quite helpful to say, if you think of everything that's happened in the last few years, I mean, we had the mini gilts crisis not that long ago, and the scheme's funding position is still in a healthy position. Now, we're sitting on the left-hand side with the lower risk strategy. And in a really doomsday scenario, we could have been coming to you asking, in this particular case, for £42,000 from an employer with an £800,000 debt, but we're not, because the scheme has been resilient and has managed to ride through that. So we are talking about the downside risk. But from my perspective, and I work with the trustees, we are very worried about the downside risk. But as they said, there is an equal upside risk. We could set out on a strategy and actually find that we get there more quickly. But what we don't want to be in the position where we're coming to you with some bad news and asking for money that we know a lot of you wouldn't be able to pay.
So I should probably just make just a couple of points. One is, there aren't any zero risk options. So we obviously have got to illustrate in some way so you can have an appreciation for the level of risk that might be there. And we keep talking about risk because naturally we're worried about that, and we have to think about that because there might be consequences if we're blown off course, right? As Kate said, it could be more optimistic. It could not turn out better than expected. Now, there are lower risk strategies than this one here that gets us there, estimated in 16 years. Why are we not coming to you today to talk about those? First of all, it doesn't mean those have zero risk. There's still a chance of being blown off course with those strategies anyway. And the timeline to get there being extended or contributions being required. But also the expected time to get there just felt so long that we didn't think employers would look favorably upon that. And that's because we think employers really do want to get out of this scheme as soon as feasibly possible. When we call these lower, medium, and higher risk, I also just want to make the point that the higher risk strategy these are all in comparison to each other. The employer company doesn't regard any of these strategies as unreasonable or reckless. We do believe all are feasible, all are worth considering. The higher risk one here doesn't mean the extreme levels of higher risk. We've not come to you today with those on the table. So we think, the slide says it for itself, we are kind of positioned with the medium or higher as ones that we think are viable and the ones we really want to put forward for consideration. We're keen to get your views as to what you think, because the employer's attitude to risk is important here. And once we get everyone's views, we'll take all that into consideration, and then we'll have the further discussion with the trustees. So we appreciate there's a balance, as we said, which means these things aren't very simple to think about. But a number of you have already, I think, probably hinted at where you're thinking. So time frame to get to the end. How critical is that for yourselves? I think will be a very big influencing factor in which strategy we think is preferable. And balanced against the time frame is, of course, the risk that we are blown off course on the way there. And if we are, then it will either impact the time frame itself, meaning it'll take us more time to get back on track, or it may be that in an extreme situation, the trustees want to have a discussion about employer contributions. It's important to understand the risk, the additional risk, if we are trying to get there quicker. So, key question here, what is your appetite, given what we've said today, knowing the risk of higher contributions possibly being needed if we were going to try to get there quicker versus slower, compared with, on the other side of the coin here, time frame to get there? What is more important to you, and where does that lead you in your thinking about which of these strategies we should go for? Should we be trying to get there in around 16 years? Should we be trying to get there in 13 or 11 years?
Right, so looking at the next steps, as we said, what we're having to do is try and assess where we want to be. What we've actually assessed, and we need your views on, is is buyout the ultimate end game? The proposed extensions to the lock-in rule, obviously to 30th of June 2027, and and the investment strategy options that we've put forward. The idea of what we're doing is we're doing these road shows. What we're also going to do is we're going to issue next week, after we've done the webinar, we'll issue a questionnaire to everybody as well to assess what people's appetite is and what they feel is a good way forward. And really that's probably going to bring this session to an end now. I would suggest that we stop here, have a comfort break, come back in 5 minutes with a coffee, and then we can carry on, by which time Kate will have gone, and we'll have shut down the video recordings. If everybody's happy with that.
Can I just say, given this is the last opportunity that I have to say anything, if you take one message away today, please let it be that the scheme is in a good financial position. What we're talking to you today about is getting from where we are today, which is a good, stable financial position, to the end point where you can all walk away. This is going to be my last Employer Roadshow because I'm moving on from plumbing pensions, but I am confident that I'm leaving plumbing pensions in a really, really good state. There's a really good team of people in the office in Edinburgh that are there to help you. If you've got any questions, if you need any information about your debt estimate or anything, give us a call because we're happy to help. And the board of directors, both on the employer company, on the trustee company, on the admin company, they're all passionate about doing the right thing.
We're now moving back into the live session. So we're having an open session, question and answer. If I can invite people to join us, which is Graham from the actuary of PPEL, Alistair, who is the director of PPEL, John, who is the chair of the pension trustees, and Kate, who is the CEO. The idea behind this is that we'll answer any live questions we've got. If you'd rather have the questions asked in the closed session with the rest of the employers, again, just make that point and we will go through from there. Okay, Sophia, have we got any questions?
We've got one question. How common is it for pension schemes to go for buyout with insurance companies?
Okay, can I throw that to Graham and then John?
Thanks, Dean. Thanks for the question. Yeah, so the pension schemes targeting an insurer buyout is hugely common across the industry. To give you a sense, multiple billions of pounds worth of these types of deals are done on an annual basis, and it's absolutely expected that will continue in the future. I think, yes, so generalising across the industry, it's fair to say that the vast majority of pension schemes are targeting that type of insurer buyout. So yeah, the insurance market is really well set up for it, and you are treading a very similar path to the vast majority of the market. So yeah, from that perspective, yeah, a lot of comfort to be taken that yeah, you're along a similar line to many. And there is the infrastructure within the market there to allow it to be delivered when we get to the point where we have enough assets to be able to transfer to an insurer.
John, any thoughts or comments from the trustee side?
Just underlining what Graham has said, I think it's still very much the gold standard in terms of exit strategy. A very big market, a very active market, and a very competitive market. So, yeah, still very much what we're focusing on as our target.
Okay, I've got one other question, which is please advise what the triggers are. We're looking to sell the business and contingent liability will likely be an issue. I think I'll probably answer that one, and John, Kate, please step across afterwards if you want to add some clarity. I think it's an issue in terms of that. It's something the membership of the pension scheme is something you're going to have to declare in any business sale, and then that'll be a matter for negotiation between the buyers and the sellers. From my point of view, there's no actual triggers involved. I actually do agree with the advisors of the trustees, which is that just because you know the value of the Section 75, you don't have to put it in your accounts. I was unfortunately the CFO of a company which was in another multi-employer scheme, and we spent a long time agonising over this. So basically, I think it's really just a matter of a discussion. You have to declare it. If you don't declare it, then you could be in problems later in the process. John, Kate, anything to add?
I think just take advice. I think that's the key thing for employers in that situation. Come to Plumbing Pensions, we can provide information, but then you'll need to talk to your lawyers or other specialists to take that advice specific to your circumstances.
And that's particularly important if the employer is unincorporated, because it's a bit more complex. So absolutely, give us a call. We can give information to help in that situation.
Okay, another question we've got is, how do we plan to gather employer responses to the questions of future investment strategy? Basically, we are looking to send out a questionnaire looking at the 3 strategies to try and assess what is the preferred approach. We'll take into account the views of the employers. Then also, as I mentioned earlier on in the presentation, we also have to take into account the position of the people who don't respond as well. And with that, we'll then negotiate with the trustees, and ultimately it's the trustees that make the final decision, but it is a matter of consultation between the trustees and the employer group. John, Kate? Anything to add?
Nothing to add from me, Dean.
Only to add that ultimately the decision does rest with the trustees. That's one of their key duties, but they are genuinely really interested in the employer views on this. The scheme is underwritten and funded by employers, so it's really, really important that the trustee understands the employer's views, and that's partly why we brought the modelling work and sort of what it could mean to the employers here today.
Okay. Probably a derivative of the further one, which is who ultimately makes the decision here in terms of the investment. Is it PPL or the trustees? Alistair, do you want to maybe expand on that?
I think the trustees do ultimately have investment or strong investment powers for the scheme. The only thing I would add is that the trustee does have to seek and consult with employers to agree on a funding solution, so the valuation and where the scheme wants to get to and all that, and that is intrinsically linked with the investment strategy. So in reality and in practice, it's important that the trustee and the employer company and the wider employer base form an agreement which does tie in with the investment strategy.
John, Kate, anything to add?
Again, just underlining what both actually Kate said previously and Alistair has said just now. It is our responsibility as a trustee responsibility, but we have a duty to consult with employers, but we are genuinely interested in the views of the employers and genuinely seeking to reach agreement for the reasons that Alistair was saying. The whole journey plan needs to be joined up. It's a combination of the funding strategy, the investment strategy, the lock-in rule, and so that's where we want to get to is agreement. So we're really, looking forward to seeing the outcome of the responses to the questions you posed at these roadshows, Dean.
Okay, thank you. Okay, God, these questions are coming in thick and fast now. We've got a question: if deficit contributions did become payable and some employers can't pay, do these unpaid amounts get loaded onto those who can pay? Can I throw that at Kate?
Thanks, Dean. We would obviously work with an employer in that situation to talk to them about payment plan and what might be affordable. We monitor the employer's financial position through the publicly available information and the information that employers give us with the scheme return. I mean, I hope that we never get to that position, and that's partly why we've taken a cautious, slow and steady funding and investment strategy. But in that scenario where employers might need to pay contributions, we would work to find what was affordable. I mean, that's the most important thing, isn't it? Finding something that is affordable for each and every one of the employers in the scheme to make sure that they pay their fair share, so that that doesn't fall on the other employers in the scheme.
Okay, but is it fair to say, Kate, that if there is a gap between what they can pay and they can't pay, then it falls into orphan liabilities, which is then shared?
If an employer genuinely couldn't afford to pay its contributions and left the scheme and there was no money to pay their debt, then that does fall to the other employers, as you say, through the orphan liabilities. Again, hopefully we never get to that position. The scheme is nearly 50 years old and we've never had to ask employers to pay anything other than their sort of core contributions. So we are talking about a hypothetical situation here at the moment.
Anybody want to add anything? No? Another question we got is, does the trustee board keep PPEL informed on their investments? Where can we find this information? I can answer from PPEL's perspective, which is yes, we are informed. We have a good working relationship with the trustees. I like to think it's quite open and transparent in terms of where we are on the journey plan. And in terms of the investment reports and strategies, they're produced quarterly, and Kate, they are available on the employer website if you log in.
Exactly. So everything on the quarterly investment updates that goes to the trustee, they share with PPEL, and it gets posted to the employer portal for all of employers in the scheme to see.
Another question is, when does the scheme foresee equilibrium in terms of liabilities versus actual fund value in terms of years? John, Kate, do you want to answer that from the trustees?
Shall I go first on this one? I mean, in terms of the ongoing financial position, the technical provisions, when are we likely to be fully funded? Well, the valuation results showed that there was a shortfall of about £9 million in April 23. The funding position gets monitored quarterly and it's deteriorated a little bit, but it's broadly in balance on an ongoing basis. In terms of when we get to full funding on a buyout basis, because that currently is our ultimate target, that depends. That depends on the discussions that we're having with employers. That just depends on the feedback that we get. With the current slow and steady approach from the modelling that Graham showed you, it looks like it's going to take about 16 years. But we are looking at whether to change the investment strategy, and if we take a little bit more risk in the strategy and target a slightly higher return, then we could find that that ultimate time comes in a little bit.
Okay, anybody else want to add anything to that? Okay, next question we've got is, if a buyout was indicated on the bar chart as the end game, and assuming 11 to 16 years to get there, when you lock-in ends, when will the lock-in end? I think probably I think what the question is basically, is that when the lock-in end is at the 11 to 16 years? Alistair, do you want to answer that? Because I think we're looking at waypoints, aren't we?
Yeah, it's fair to say that, first of all, the lock-in and everything that we need to do to underpin the strength of the covenant supporting the scheme, we believe is important to have for the next 3 years at least, which is why the proposal is to retain the lock-in rule for the next 3 years. Exactly when the lock-in rule can be released is something that the employer company is is going to be discussing with the trustees over the upcoming months and few years. So we don't have an exact answer. It doesn't necessarily have to be that the lock-in ends when we actually get a buyout. It could be that there's some point before that when the scheme is in a sufficiently strong position, the reliance on company covenant has reduced sufficiently so that the scheme can withstand any volatility. And there's a strong belief that employer support isn't needed as much. And at that point, the lock-in rule could potentially be released. But exactly when that is something to be discussed between the employer company and the trustees. And we will come back to yourselves with any updates on that in due course.
John, Kate, anything to add?
Just to support what Alistair said, I mean, the scheme needs to have sufficient cushion to withstand any shocks that happen along this path to buyout. But I think that there is a point, and again, Graham's chart during the presentation showed this. I think there comes a point where there is sufficient cushion built up that even in a sort of, I won't say doomsday scenario, but a really bad year, even if the scheme's assets went down, there would still be enough for the scheme to remain on track. So there are definitely discussions to be had over the coming 3 years, if the lock-in rule is extended for 3 years, about the framework for when that lock-in rule might no longer be needed. And that's a collaborative decision that needs to be taken by PPEL in consultation with the employers and the trustee.
John, anything to add?
No, Alistair described it perfectly. I think a discussion that we will be having over the next few months and year or so.
Okay, the next question is, can a harder line be taken with those employers who do not complete their annual return? For example, can we fine them? Kate.
Absolutely, we could try, and actually by adopting a firmer line with the employer VAT invoices, we've definitely seen a much greater and quicker return of and payment of those invoices. It is a statutory obligation for all employers in a defined benefit scheme like this one to provide the trustees with the information that it needs to run the scheme. So asking employers to complete the scheme return is a totally reasonable and acceptable and normal thing for the pension fund to ask of employers. We have to this day adopted a softly approach. We've tried to explain to employers the importance of the scheme return and why we need the information and the specific purposes that we use it for. Using the employer roadshows and the employer company to get out that message of why it's important is our softly approach. But you're right, we could look at a tougher line, and I'd be interested in the views on on whether fining is appropriate, because if the employers are not engaging and sending us the information, they may just ignore the fines and it may just be a paper exercise that ends up costing us more money.
I can say from a PPEL point of view, we're here to represent all employers, so we support the trustees in trying to get this information. We think it's only fair that there's a level playing field here, and if everybody provides all the same financial information, obviously the trustees can then make decisions based on actual information rather than having to ignore 43% of the employer base. Another question I've got is, do you expect Section 75 payments to reduce proportionally as you near the 11 to 16 year position, assuming no change to the 99% funding? Who wants to take that? Kate, John?
Yeah, shall I start and then others can add to it? My initial reaction was yes, as we get closer and closer to being fully funded on a buyout, then the Section 75 deficit will reduce and the individual Section 75 payments will reduce. There's probably at least one caveat to that, which is it depends on the number of employers and the employer base. if is, you know, that the first bit I've said is the good news, that the overall Section 75 deficit reduces as we get closer and closer to the end point. But if, as we do that, lots and lots of employers disappear, either sadly through insolvency, or if, for example, there was no lock-in rule and they left voluntarily, you could have a situation, I suppose, where the overall Section 75 deficit is a lot smaller, but, you know, at the extreme, there's only one employer left having to pick that up. So that, I mean, that is a very extreme example, I guess. So I'd probably sort of veer on the positive, Dean, and say, you know, that you know, and again, subject to a significant reduction in employers, that you know, that deficit should reduce as we get closer and closer to the end point.
Okay. Anybody else want to add anything?
The deficit is on the buyout basis is triggered by a lot of different, is influenced by a lot of different factors, including the returns that you might get on government bond yields and things that happen out in the external economic environment. But the simple message is that we do expect it to reduce as we get closer to the end point.
And I think John has raised a very, sorry, Alistair, you go.
No, I was just going to say, and another factor is, if employers do leave, another factor as well, when they leave, how much money is actually recovered by the scheme for those employers. So, you know, one scenario would be employers leave, even if the lock-in rule is released, an employer says they want to leave, but by triggering their own debt, you know, they will trigger a Section 75 debt. And of course, when they pay their share of the debt, then that doesn't leave the other employers with a disproportionately large remaining share, because that helps reduce, you know, it continues along the path, basically. So a lot hinges on, if employers do leave, how much is actually recovered from those employers that actually leave. So optimistic scenario would be that lots of money is actually really recovered along the way, or employers actually remain in the scheme altogether for a long time, and along that journey we get good investment returns, and the position is strengthened more and more.
Okay, any other thoughts or comments on the panel? No. The next question is, has the shortfall of 9 million been considered to be met by the employer members, approximately 27k per employer member? Obviously, this is only an example. I think from the employer company's perspective, I can, you know, to reiterate what Alistair said in the presentation, the feedback we've had is that people don't want to make a deficit recovery contribution or a contribution itself. So we've been working and operating on that basis, and with the current valuation, that 9 million shortfall will be made up through investments, you know, the investment plan as we move forward. So there's no need for a deficit recovery in the case of a 9 million shortfall. Kate, John, anything to add?
That was a perfect actuarial explanation, Dean. Well done.
Thank you. Okay, next question is, being that plumbing is a physical job and for years we have been working around dangerous substances like asbestosis, if an employer needed to close their business on medical grounds, would the scheme look for contributions from any life insurance policy payout the employer received? Kate, John.
This depends on the employer's legal structure and whether it's a limited company that's winding up, in which case that would trigger a Section 75 debt at the point of closure, or whether it's an unincorporated employer, in which case the contingent debt or Section 75 liability would remain but wouldn't be triggered. It's a complex one. It depends on the individual circumstances. But if we're talking about an unincorporated employer, and if we're talking about a situation where the employer where the pension scheme needs employers to pay pension contributions, then we would be going out to the employers and looking at their financial assets, which may or may not include any insurance payments that they receive, any income, any assets that they have at that time.
Okay, I've got another question, which is how do you plan to gather employer response to the question of the future investment strategy? Is that something you will contact everyone about, or are you looking for informal responses from the events? We have received informal responses for the event, but we are issuing a questionnaire. We were hoping to do it this week, but it will actually be going out early next week because we need to do some work on this webinar to get it uploaded onto the site. But we will be issuing a questionnaire, which it'll just be a simple questionnaire which you can vote and return on. Cool, the questions are still coming in. Is there a timescale if or when the current strategy is to change to the medium-high risk strategy? From PPL's perspective, I can say that that's something we are currently negotiating, and once we've reached agreement with the trustees, that's something which we'll then we'll look at in terms of looking at how that will be achieved through the investment plan. Alistair, John, Kate, anything to add?
Well, from my perspective, I don't not really. I mean, I think we need to get employer views. We need to then agree what we're going to aim at, how we're going to get there, what the strategy looks like, and then we will put in place an implementation plan. So I would say as quickly as we can feasibly do, we move from the current investment strategy to what the investment strategy should be to achieve the target returns that we're aiming for. That in reality will take a number of months, but I can't say at this point exactly how long it will take. I mean, Kate and John might have a view on this.
In practice, it could take a bit longer than a couple of months. The scheme has some quite illiquid investments. It invests in property and property-like assets, and they can be quite slow to sell and find buyers for. We're not fire sale investors. We don't want to be selling the assets below the right market price. So the scheme would want to make sure that they took the time to sell any illiquid assets at a sensible price. But once a decision is made to change the investment strategy, that would be implemented as quickly and effectively and efficiently as possible.
Okay, that appears to be the end of the questions in this session. We'll obviously be moving into the closed session, which is the employers only. Can I take the opportunity to thank both John and Kate for joining us on this presentation, and from the PPL's point of view, can we also take the opportunity to wish Kate success in her new role and to thank her for all her hard work over the last few years. John, anything you want to add?
No, thank you, Dean. Thanks, everyone. We shall leave you to your closed session.
Thank you very much. Okay. Okay, moving into the closed session. I think really this is we're not quite certain how this will work on a webinar basis, but what we're trying to do is try and expand a little bit on the employer company views on the journey plan. Just to announce quickly that we've got a process for electing directors and basically anything else that comes out from the process. So if we move on to the next slide. The three people on the screen are the three that will be speaking. And again, hopefully we will try and do this as an interactive basis, but we are aware of the fact that obviously it will be by written questions. Moving on. Alistair.
I'll be brief on this because we've sort of talked about it before. So really, this is just telling you again what we're trying to achieve and what we're coming to you to get your views on, which is, okay, we want to aim for buyout. We believe that's the appropriate end game strategy. And the trade-off here is how quickly should we aim to get there? And what we want to get your views on is, well, if we try to get there quicker, there is a risk of being a higher risk of being thrown off course. That could mean setting us back a bit in terms of how long it takes to get there or contributions being required. With all that in mind, between trying to get in around 16 years to the other end of the spectrum around 11 years. These are the ones that we have put to yourselves. We want to get your view as to which ones you would prefer. From the employer company perspective, I'll just say again that we believe this whole range of strategies are all viable. So it really just depends on employers' perspectives, including trying to get there with a bit more risk at the higher end towards 11 years or possibly in the middle, 13 years. So we put up the next slide, which just sets all this out again. And I think at this point, I don't know, Graham, if you want to say anything, but otherwise we kind of want to open the panel up for questions, feedback.
Yeah, thanks, Alistair. Yeah, but largely to reiterate the points that have been made, the three strategies that are on the screen, we feel are all reasonable and worth consideration. We've not considered anything that has risk that we feel is irresponsible. And there are even lower risk strategies that we feel would just take too long to get to buyout, which we've not considered. So each of these feel reasonable. Yeah, and I think what we'd like to do is just get your feel of what you would prefer in terms of this trade-off between the shorter time frame to get to buyout, but the shorter that time frame gets, the more the potential downside risk of bad outcomes increases. So yeah, pause there. Happy to go into any more detail if there's anything specific you want to bring through the questions, but I think over to you for views and other thoughts.
I think what might be useful is potentially having a discussion. Obviously it's quite hard. We've got lower risk, medium risk, higher risk. In terms of that, whilst we don't have the exact numbers involved, what sort of investment levels are we talking about in that area?
So yeah, I can go on the lower risk side, where yes, somewhere in the region of around sort of 5% or so. So looking at returns of 5% a year from the assets. At the higher risk side, that looking about closer to 6%. So that sort of range. So somewhere between 5.5% and 6% at the higher risk side. But yeah, just to try and give you a kind of sense of the scale. But that would be targeting returns of between 5% and 6% each year from the asset returns.
Okay. One question we've got is, will this decision be reviewed in the future? If things aren't going well with a higher risk investment, do we have the option to review that and shift towards a lower risk option? Alistair?
I think that's right. We will, once we implement the strategy, we will be monitoring it on an ongoing basis, and we'll react according to the circumstances, both ways. If we get thrown, of course, but also if being more optimistic and things turn out that we're getting there quicker, we will also be reviewing where we are and what steps we should take at that point.
Yeah, and I think the point to make, just to re-emphasize that, is obviously with the fact that we have, we obviously have access to the investment plans, as you do as the employers. You can see the asset and reports. That's something that we obviously do monitor quite closely with the trustees. Another question is, do employers have a say in whether we pay contributions or extend the journey plan by a few more years? Alistair first and then Graham.
Yeah, absolutely. As we are getting your views now and consulting with all employers, that's exactly what we will do in a scenario where we're thrown off course, or in any actuarial valuation that suggests there's a level of underfunding that might require contributions, and we'll weigh up the options as to whether the timeline should be reviewed, or the investment strategy be reviewed, or the contributions might be required, or it might be a combination of more than one thing. But absolutely, we will consult with employers and get their views and negotiate with the trustees accordingly.
Yeah, I would completely agree with what Alistair said there. We'll where that situation to occur, there are a number of angles we would come at it from, in terms of yes, sort of levers that that we have, and to use to consider to potentially reduce or take away the need for contributions, and we would consult with you on each of those.
Okay, the next question is, the journey endpoint in 2020 was stated it would be 2040, 20 years. 3 years later, at the same low risk level, it may only be 2039, 1 year better. Is this performance of the investment fund at an acceptable level? Alistair.
I mean, I think if everything went exactly in according with trajectory back in 2020, you would expect 3 years on to be 3 years further. So we might be saying it's around 17 years from 2023 to get to the end point. So that's the first thing I should say. Now, despite all the volatility that's happened over the last few years, the scheme has actually rolled that out quite well. So I think the scheme has actually done pretty well and is in a positive position. And what we're coming to say to you today is that actually, with the current investment allocation, we expect to now get there in around 16 years, actually. And there are viable ways that we believe we can get there even quicker. So in 13 years or 11 years or some number in between, shall we say. So I think I would phrase it as there is a positive message here as to where the scheme has come to, but we think we can now potentially accelerate a bit and get there quicker, which we understand is what employers really want to achieve.
Yeah.
So again, I think, as was said in the presentation, it's quite interesting if things, if the way the scheme was managed hadn't been as well managed, then obviously you were looking at a potential deficit of 70 million, because the last 4 years has been quite volatile. But the scheme has managed to weather this and has come forward with a deficit over that period of only 9 million. Graham, anything to add?
Largely reiterating what was said, but over the last period since the last valuation, so 3 years, it has been a really volatile time in investment markets. The fallout from Liz Truss's spell as Prime Minister was a really rocky time in investment markets, and there were a lot of pension schemes that didn't ride through that anywhere near as well as the scheme has. So a lot of positives to be taken from finding ourselves actually slightly ahead of the this expected time frame to buy out, and now with more options to potentially reduce that time frame even further.
Okay. And the next question we've got is, what in practice would be the investment change to move to a medium or higher risk? There is a significant prevalence in LDI investments in the current asset profile. Accepting that these are designed to match the liabilities, they have also insulated the scheme for any potential equity gains over the period that they have been in place. Annuity prices have significantly declined recently with increased interest rates, and equity prices have not shown a similar decline. Any thoughts?
Yeah,
there will be discussion of, as I said, an implementation plan, and a lot more detail of exactly what the investment profile would look like to achieve the returns that we're aiming for once we agree what we're aiming for. I think in reality, We will want, I mean, the trustees aren't here, so I can't speak for them, but we will, I believe we will want to retain hedging against increases in inflation expectations or interest rate expectations. So the LDI strategy will remain quite important. But because we want to achieve some higher returns, there will be a shift in the investment strategy. It could include, for example, having a bit more in the likes of credit and equities. But I know that sort of some of the assets that we locked into will ultimately we will try to get out of them, which Kate said earlier could take more than a few months to get out of. So the liquid assets, for example, would probably be reducing a bit in the new framework. But we can't really tell you exactly what it looked like today, but we will certainly be sharing the detail of what the investment strategy will look like to achieve what we want.
Graham, anything to add?
Yeah, from the PPEL side, in terms of the process we'll go through from here, once there's been we've got the feedback from employers and fed that back to the trustees, and then reached agreement at this target level of returns. We will be, the trustees will propose a strategy, and what I mean by that is that the assets that they'll look to achieve this expected return on assets with, that will be shared with PPL. It will be scrutinised and challenged if we feel it's necessary. I think the objective is very much to deliver whatever we agree is the target return in a fashion that we reduce risk as much as possible. So yeah, there will be a robust process that's gone through and in times shared back with you. As Alistair said, yeah, unfortunately at this point we don't have the details, but yeah, rest assured there will be a keen eye placed over what is proposed and implemented.
Okay, we seem to have run out of questions, so I will bring, if we don't have any more. Sophia, have we got any more questions? No. I'll bring this session to an end then. Thank you very much for participating. Just a quick note that, as mentioned earlier on, our board is constituted of a number of people from employers. We are looking at we have a set period in terms of how long we stand, and our first director comes up for re-election at the end of this calendar year. This is just a flag to say that we are looking to go through the process of electing a director for a 4-year term. If it's something which interests you, please drop an email to the inquiries line, and we'll have a discussion. In terms of that, next slide. It's just basically saying, thank you very much for attending. Thank you for participating. I hope this was useful. As we mentioned, it will be uploaded onto the employer portal, the whole session, both the open and closed. And, we will be sending a questionnaire to you next week to try and formulate what responses and what approach you would like to take. In the meantime, could I thank everybody for joining us and participating? Can I also thank Sophia for her hard work in the area? She's one of the hidden people in the background who has managed to bring this all together, both at the roadshows themselves and also this technical event as well. So bringing it to a close, just say thank you very much, and good luck, everybody.
Yes, thank you, everyone.
Thank you.